Business Value podcast. This podcast is brought to you by Mastery Partners, where our mission is to equip business owners to maximize business value so they can transition their business on their terms. Our mission was born from the lessons we've learned from over 100 business transactions, which fuels our desire to share our experiences and wisdom so you can succeed. Now here's your host, CEO of Mastery Partners, Tom Bronson.
Hi, this is Tom Bronson, and welcome to Maximize Business Value, a podcast for business owners who are passionate about building long-term, sustainable value in your business. This is a special episode. If you missed the Business Transition Summit in Irving, Texas 2 weeks ago, then today I am delivering the second half of my keynote address, Maximize Business Value Playbook, 10 specific actions to dramatically increase the value of your business. If you missed last week, go back and listen to last week's episode first, and then come back to this episode because this will wrap it up and round it out for you. If you remember, the chapters then, or the numbers that I'm going to refer to, are the chapters in my book, Maximize Business Value Playbook. And so if you're playing at home, then you can follow along. Number 35. If you don't do anything else I tell you, do this one. Document your company processes. This recommendation is the single biggest thing you can do to improve the value of your business. A business with clearly documented, repeatable processes is always more valuable than a business that has none. Without duplicatable processes, it's sort of like running a business playing the corporate version of the telephone game that we played as children. The owner starts the business and hires the first employee and trains them how to do things the right way. Later, the business expands and that person hires and trains the next person, and then they hire and train the next person, and so on and so on. With each new hire, the training experience changes until one day the owner doesn't even recognize what's happening in their own business. The benefits of having solid documented processes are countless, but here's a few things. It reduces errors. It makes training easier. It minimizes knowledge gaps. It helps adhere to compliance requirements. It defines expectations. It mitigates risks, and I could go on and on and on. Now, let's get back to our heroes. Remember Tom, oh yeah, and Tom, dang it. So when asked how long it takes to get a typical frontline new hire up to speed, Tom, oh yeah, confidently replies that they're able to do the simple things in about a week and the more complex things in a few weeks because his team has meticulously documented all of the critical processes and they use them to train new hires, which is also allows them to update their processes with minor changes on a regular basis. Now, Tom, dang it, when asked the same question, he said, maybe 6 months, maybe 12 months. But I like to give everyone the freedom to do their job in the way they see fit. It makes us more efficient and builds a strong company culture. So my recommendations to you are: document your key processes to establish consistent, renewable, or reviewable strategies to manage your business. And if you need help, hire a professional to help you. If you don't know a professional to help you document your processes, reach out to us here at Mastery Partners, and we will be happy to help you. Help you find someone, that is. Now, this is one of those magic bullets that every business owner needs, and it's one of my favorites. Number 36, identify and track key performance indicators. Key performance indicators, or KPIs, or metrics, are numbers that can help you identify whether you're on track or off track in your business. They can be measured daily, weekly, monthly, quarterly, annually. KPIs, again, as I said, also known as metrics, are critical. Thorough and intentional KPIs can indicate whether your business is doing well and can simultaneously hint at the weak parts. Now, don't just make a giant list of everything and measure it all. Pick the drivers in your business that set goals to achieve the desired result for each target. In doing so, The team will know if the business or the department, whatever your KPIs are for, is on or off track. An excellent place to start is benchmarking against your industry. Many industries and trade associations commission benchmark studies that are sources of good data, but I do caution that while industry benchmarks may be a good place to start, KPIs should be specific for every business, and they should hone in on the goals of that specific business. Now, once the right KPIs are determined, and they have to be consistently measured, then action can be taken to train or to make sure that the train, stays on the right track. Although there's some debate over whether or not he actually said this, the great Peter Drucker taught us that you can only manage what you measure. Boy, getting tongue-tied here. You can only manage what you measure. And that means having great KPIs. Now, Tom, read a book along the way that said you can't manage what you don't measure. So for a long time, he's been measuring everything he could think of. And before long, he had a list of over 200 KPIs on his weekly list, and he realized that it was becoming a full-time job just to manage the metrics. Now, that's when he and his team sat down to determine what are the 10 or 12 things in each department, those things that will give us clues on what's going on in the business. And of those, what are the 2 or 3 things from each department that we can roll up and report on every week? Those are the ones that he could review with his management team each week. And if something doesn't look right, they have more metrics in the department level that they could drill down into and find the cause of any problem. Now, Tom, dang it, had one metric, cash on hand. Now, although that is a great metric to measure, it's hardly enough to help him run and drive his business. So my recommendations here, determine your KPIs and create a scorecard and measure the results relentlessly. Let's talk about number 42, growth initiatives. Many, dare I say most, small businesses remain flat with little or no growth for many years. For them, the business is about balance. Let's face it, growth is a lot of work. And if the owner is comfortable with the income the business provides, why work harder to grow the business? Let me say it as plainly as possible. A growing business is always more valuable than a flat or declining business. Many small business owners don't care about growth because the business has become a lifestyle business, meaning that the business exists to support the owner's lifestyle. Now, look, there's nothing wrong with that on the surface, but business owners who treat their businesses that way usually miss out on a great opportunity to build that long-term value that they can harvest when they exit. In most industries, businesses trade within a range of multiples of earnings. For example, let's say you're in a particular industry that trades at 3 to 6 times earnings. But where do you fall in that range? Businesses that are flat almost always trade on the lower end of that scale, while businesses that are growing at a reasonable pace compared to their industry averages typically trade at the higher end of that scale. Now, I know what you're thinking. My business has so much growth potential. Many business owners think that their business value is based on the future growth potential of the business rather than the past performance. They recognize that there is growth potential, but they haven't invested in realizing that potential because it's risky and they're just plain comfortable where they are. Now, unfortunately, buyers value businesses based on past performance, not future growth, unless, of course, the business is genuinely disruptive. Think Uber in this case, or Amazon. Now, if you're fortunate enough to convince the buyer that they should pay you for your future growth, what your business is worth in 5 years, then it's guaranteed to come in the form of an earnout, which, unless it's properly structured, can be absolutely worthless. That's a class for another time. We'll get into that another day. So, business owners with a flat or declining revenue graph for at least the last 3 to 5 years need to kick it into high gear and get that arrow moving up and to the right profitably. I have some thoughts on how to do that, but if they want to maximize the value at exit. So let's see how our heroes are doing. Tom at Oya Industries has enjoyed a 25% compound annual growth rate for the last 5 years. Tom invests in both his sales and marketing teams, and every person has a target KPI, which they measure relentlessly. His sales training is top notch, and he can count on his new hires to be fully productive in about 3 months in a highly complex sales environment because he has clearly defined duplicatable sales processes. And if new hires can't achieve the 90-day performance standard, his sales manager invites them to think of a new catchphrase in their new career. You want fries with that? Now, Tom, dang it, at Dang It Industries, much to the chagrin of his sales manager, Tom personally handles his top customers. He's on his fifth sales manager in just 4 years. Some years are slightly up, some are slightly down, but no matter. The business supports Tom's rather extravagant lifestyle. And again, it's highly profitable. So, my recommendations here are get serious about developing a solid growth strategy every year for at least 3 years before exiting your business. Step out of your comfort zone and investigate opportunities for business growth. And here's another idea about that. One of my personal favorites, number 43, find ways to build recurring revenue. Buyers love predictable revenue, and you should too. The past performance of a business is very important in determining the value of a business. However, buyers are ultimately purchasing future cash flow, and the best way to show predictable future cash flow, removing risk for the buyer, is to convert as much business as possible to recurring revenue. And by the way, you can convert nearly everything to recurring revenue. Did anyone think you'd ever have a subscription to wash your car? Well, they do, but let me give you a personal example. In 2004, traditional purchase options dominated the restaurant industry, software, hardware, and services purchased or leased upfront. That's when I started experimenting in one of my companies with a monthly recurring payments model. By 2008, we had fully implemented a process to sell software, services, and hardware for one low, convenient monthly payment. Now, admittedly, doing so required us to raise capital to fund the hardware and the delay in profitability. Again, a class for another time. But we were able to take our business from 4% recurring revenue in 2001 to over 70% recurring revenue when we sold the business in 2018. Now, trust me, the buyer absolutely loved it. And as it turns out, while we didn't know it at the time, we were on the bleeding edge of the SaaS-based businesses, which, because clearly now all restaurant technology is purchased on a recurring revenue model. Now, converting revenue streams to recurring is tricky. I get it, but it's eminently doable for most revenue models. It may require a bit of creativity, but it's worth the effort. Now, if you can find a way to create recurring revenue in your business, it will become more attractive and more valuable in the eyes of a buyer. Now, understanding that recurring revenue drives value, Tom, challenged his team to think about every single revenue line and find ways to convert it to recurring revenue. Now, although his industry is really hard to convert, he's up to 40% recurring revenue, and that percentage is growing every year. Looking back, he now realizes that having that recurring revenue is automatic and pays for his overhead every month at the push of a button. He wishes he'd done it sooner. Tom, dang it, thinks that there's no way to get recurring revenue in his business, and besides, he wants the cash up front anyway. Consequently, he has no recurring revenue. So my recommendations here, look, I get it. Not every business can convert to 70% or 100% recurring revenue, but I bet there's something in your business that can be converted to recurring revenue. Find it and get to work. And if you do this in an industry that doesn't traditionally have recurring revenue, you'll be able to convince buyers that your past performance is very duplicatable and they will love it. Finally, the last one that I'm going to go into, this is number 10, owner dependencies. It's actually chapter 54. Many business owners thrive on being the only person who makes the business tick. They wear that like a badge of honor. But unfortunately, when it comes to selling or otherwise transitioning the business, if the owner is the only one who knows everything, guess what happens to the value of the business when all that tribal knowledge walks out the door or otherwise disappears? Owner dependency is one of the biggest obstacles to business transitions. A lower middle market business, so under 10 to 100 million in annual revenue, that is owner dependent, will take a haircut on valuation, typically as much as 25 to 50%. Ouch. A Main Street business, which under 10 million in revenue, might actually be worthless. Double ouch. Now, if that sounds like you, I challenge you to become expendable by investing in people and systems. Take action to document all of those things that only you can do. Make a list of them and relentlessly document the processes. Once the processes are documented, consider training others to do some of that work. Now, I've always tried to operate my businesses as an investor rather than an operator. Investors are passive when running businesses, and operators are up to their eyeballs in it every day. Now, for a business owner who doesn't know if they're an owner operator or an owner investor, think about the number of things that only you can do in your business. That will give you a clue. Try taking a 3-week vacation and unplug. If that sounds impossible, you might be an operator. If that sounds absolutely delightful, you're probably an investor. And finally, try another test. Try asking yourself this question: what would happen in my business and my family if something happened to me? And be honest. Now, look, business value dramatically improves the minute it is no longer dependent on the owner. Besides, if you're tied to the business, that doesn't leave much time for other priorities like family, community, and causes. Now, Tom, oh yeah, definitely had a personal crisis a few years ago when his marriage almost fell apart. He realized that he was working 18 hours a day, 7 days a week, and something had to change. So he gathered his team together and slowly started offloading things to them and delegating things to them. And now he has a solid team, and he's confident if something happens to him, that they will be able to run the business. Tom Dangan, on the other hand, really wants to trust people to do more, but deep down, he really thinks he's the only person who can do most of the work. And that's unfortunately maybe true, because Tom doesn't exactly hire the kind of people who rise to the occasion. So my recommendations here: document the processes that only you know how to do and make sure that others understand them, and schedule a 3-week vacation, for crying out loud, and try to unplug. So let's see in our 10 points how our heroes fared. As we already know, both businesses are approximately the same size, with the same EBITDA, with the same number of employees, serving the same market. And at this point in time, you couldn't find two businesses that are more identical. And that's only on the surface. Oh yeah, industries and dang it companies are in an industry that currently trades at 6 to 8 times earnings for a business their size. Ironically, both businesses were approached by the same buyer. Their initial offer was identical, 7 times earnings, which they both eagerly accepted. And then It was time for the dreaded due diligence, where the buyer would dive deep into the business and make decisions on adjusting the purchase price after they see what they discover. If you've never been through due diligence, it's kind of like getting a root canal every day for 90 days or 180 days. It's kind of fun. Not. So just like any buyer, let's see what they discovered. At Oya Industries, do you know what your business is worth? You betcha. And dang it, as much as I can get for it, but at least 100 million. That's what I'm hoping for. Do you require monthly financials by the 15th? And oh yeah, absolutely. By the 8th, if I can get them. And dang it, do we have financials? Do you measure ROI on everything? And oh yeah, we won't start without it. And dang it, what does ROI mean again? Do you budget before year end? Oh yeah, we're fully baked by October. And dang it, gut baby. Do you use a business operating system? At oh yeah, they use EOS. And dang it, they think it might be Microsoft or maybe it's QuickBooks. Yeah, I think maybe it's QuickBooks. Do you document your processes? And oh yeah, most of them are documented, but it's a work in progress. And dang it, if people ask, I'll tell them what to do. Do you identify and track KPIs weekly, monthly, and quarterly? Oh yeah, all on a scorecard. Dang it, we got cash. We must be good. Have you examined your growth initiative? Oh yeah, 25% 5-year CAGR, compound annual growth rate. Dang it, we're flat, but we're really, really profitable. Have you found ways to build recurring revenue? Oh yeah, 40% and growing. Dang it, don't like it, never will. No way, Jose. Have you found a way to eliminate owner dependency? Oh yeah, we have a great team. Dang it, I'm the man. So after due diligence, oh yeah, signed a definitive agreement and closed at 9 times earnings over the industry trading range. Dang it's offer dropped to 4 times. And in a very emotional state, he walked away. It just wasn't enough to continue to support his lifestyle that he'd come accustomed to. His chances of finding another deal are minimal, and that's a shame. So how do you want your business story to end? Yes, there are things beyond your control, but there are lots of things that you can do that are completely under your control, that you have control over, and you can significantly impact the value of your business. I say, know the small decisions that you can make today and that can add up to the exit of your dreams. And then take action on them and do it now. The outcome will be a lot better if you do. This is the Maximize Business Value podcast, where we give practical advice to business owners on how to build long-term sustainable value in your business. Be sure to tune in each week and like us wherever you found this podcast. Until next time, I'm Tom Bronson, reminding you that every business on the planet will eventually transition. So it's never too early to start working on your ideal exit while you maximize business value.
Thank you for tuning into the Maximize Business Value podcast with Tom Bronson. This podcast is brought to you by Mastery Partners, where our mission is to equip business owners to maximize business value so they can transition on their terms. Learn more on how to build long-term sustainable business value and get free value-building tools by visiting our website, www.masterypartners.com. That's master with a Y, masterypartners.com. Check it out.
That was perfect. I wouldn't make any changes on that.